Hello, today we're going to talk about the effect of financial leverage on firm value. So we have seen some firms like Apple, Microsoft, they were debt-free for a long time. Other firms in the real estate sector or auto sector, they use a lot of debt. So it doesn't matter you choose a mixture of more debt or less debt. So the choice of the mixture is called capital structure choice. We really want to ask, would the change in capital structure choice affect firm value? That is, if you switch from debt-free to capital structure with some debt, does it matter? So if you're the manager trying to boost the performance by the end of the year, if you know the capital structure matters, you may want to do something about it to make shareholders happy. So how do we measure capital structure choice? You heard of leverage ratios, debt equity ratio, or debt to value ratios? So if company's debt is $2 million, equity is $3 million. So this makes total value is 5. So the debt equity ratio is going to be 2/3, while debt value ratio, or sometimes we say percentage of debt or weight of debt, equal to 2/5, 40%. So these are the two ways to describe leverage, debt equity ratio or debt to value ratio. When company change from one capital structure to another, we're going to talk about this process. It's called capital restructuring. If you look at two circles here, green represent the amount of debt, proportion of debt. So this one is going to increase more debt. To do so, we're going to borrow, issue debt, and buy back equity. We could also do another way around. That is, we're going to sell stock and pay off some debt. So these two type of example refers to capital restructuring. When we do that, basically we are swap one part of capital from equity to debt or from debt to equity. When we do this, we keep the total capital constant. The reason is that we do not want to change investment decisions. If we have more capital, we could invest more. We could make more money. So we don't want to mix these two decisions. Here, we only focus on capital structure choice, not investment decisions. So which one is better? How do we evaluate and compare the choices? A simple rule is, are you making shareholders happy? So the capital structure which maximizes shareholders' wealth or the value of firm is a good one. Sometimes it can also be reflected in the discount rate, WACC. I'd like you to take a look at this example. Currently, firm has a debt-free capital structure. There's no debt. Company has 500 shares outstanding. Each share are worth $10. On the proposed capital structure, company is going to borrow some money and buy back stocks. So they're going to borrow $3 million at 10%. And they're going to reduce equity to $2 million. The total capital is still the same. In this case, the equity ratio 3/2 is 1.5. Share price remains $10. So how do I find out the new shares outstanding? Remember, we borrowed $3 million and we purchase back stock. Each one costs $10. So this means we're going to buy back 300,000 shares. As we have originally 500,000, buy back 300,000 means we are left with 200,000 shares. Let's look at the performance under two capital structure. Suppose we are shareholders. All we care about is the cash flow paid to me. So suppose I have 200 shares. All I care about is how much dividend or how much earning per share I'm going to receive. So let's figure out earning per share or return on equity under two capital structures. We start with the one, no debt. I need to mention that under this discussion, we assume there's no corporate tax, perfect capital markets, no transactions, competitive, no corporate tax as well. And to capture future uncertainty, we assume there are three economies: recession, expected, expansion. Companies' earning ability, EBIT, are given here: $300, $650, and $1 million. As there's no corporate tax, the net profit is based on the earning EBIT and interest payment. There's no interest payment as we don't borrow. So net income, net profit, equal to EBIT. So how do I find out earning per share? Earning per share equal to net income over shares outstanding. So we do have 300,000 for the recession case, net income. So our shares in the previous slides, we have shares outstanding 500,000. So each earning per share is 60 cents. So recall we owned 200 shares. So this means we're going to receive $120. How do I find out return per equity dollar invested? ROE, return on equity, equal to net income divided by total equity. For no debt, total equity equal to firm's total value. So this gives us 6%. We can do the similar calculations for expected and expansion cases. So now let's take a look at the proposed capital structure. The three economy and the EBIT are the same. So what is different now, as we borrow the $3 million, we have to pay interest payment. The cost of debt is 10%. So the interest payment will be $300,000. So this is going to be fixed under each economy. Now our net income will become 0, 350, 700 under three economy. Let's find out earning per share for the expected cases. Again, we're going to use net income 350,000. Under proposed capital structure, we borrow money, buy back shares. The new shares outstanding is 200,000. So this gives us the earning per share is $175 per share. If we have 200 shares, which means we're going to earn $350. Which one is better? Which one is worse? Let's put them all together side by side. So this chart shows earning per share and EBIT. And the navy solid line is current cap structure. There's no debt. The broken line is proposed one with $3 million. As we see, it is not always better, and two lines cross over at one point. We call break even. If your earning is above break even, seems debt is better. Debt is going to improve earning per share. If our earning is below EBIT, seems lower debt or even no debt helps you. So how do we do this in practice? How do we make recommendations? If you are the company doing solid earnings, solid performance, like Amazon, Apple, don't worry about not being able to pay off the interest payment, go with more debt. If you're some company like a Kmart, Macy's, struggling, try to compete with online giant Amazon, if their earnings is hit or miss with too much uncertainty, then probably want to consider lower your debt. Another observation from this chart means we notice the slope of this line becomes steeper for levered capital structure, which means when we increase leverage, our earning per share is more sensitive. So how do we find our break-even point? So it is actually simple to understand. So imagine we have two lines, both have the crossover at one point. So at this crossover, we both have same earning EBIT. So we just list the earning per share. For the no debt case, earning per share, the net income equal to EBIT. we had 500,000 shares. For the one with that, we do have to subtract 300,000 interest payment. Our shares is reduced to 200,000. So use algebra rearrange, we could get break-even point is $500,000. So to summarize the effect of leverage, we do notice leverage not always better or worse. We do see leverage seem to amplify the variation observed in earning per share and return on equity. So slope is steeper. Basically, that means leverage makes our performance earnings risky. So here included an Excel template. You can take a look at previous examples. So that's all for the effect of leverage. Thank you.